Around the world in 25 minutes. Zuerst die Pandemie, dann der Ukraine-Krieg, angespannte Energiemärkte, hohe Inflation, restriktive Geldpolitik. Die Weltwirtschaft steckt in einer veritablen Schwächephase. Wenn das die Planbarkeit von Unternehmen betrifft, dann ist das ziemlich herausfordernd. Wie es jetzt um die Konjunktur bestellt ist, welche Risiken, Branchen und Regionen betroffen sind, das werden uns jetzt die beiden Ökonomen Christiane von Berg, sie ist Head of Economic Research, Coface, BeNeLux und DACH, und Grzegorz Sielewicz, Head of Economic Research, Coface Central and Eastern Europe, beantworten. Ich darf die beiden auf die Bühne bitten.
Thank you. Vielen Dank, grüß Gott. Schön, Sie alle wiederzusehen. Great to see you again. It's a pleasure for me to be always here with my colleague Grzegorz, so we are happy to be here. The title of this presentation is Around the World in 25 Minutes.
Just 25 minutes?
Yeah,
yes.
Just 25 minutes. I mean, come on, guys. And this morning we went through the presentation and we realized it's mostly located on Austria, to be honest. Sorry, guys, just to make it sure, the world is not Austria. I know you would like to have it that way, but it's just that we realized that Austria is quite a good example for many problems that we have in Western Europe. And I do not mean by that Austria is the problem, but Austria has the same problems as many others. So I hope now everybody is set for it, and you can start with the country risk map.
Thank you, Grüß so that's my great pleasure to be here together with my friend Christiane. Thank you, Dagmar, for your invitation, especially that this is this 20th anniversary of the countries conference here. I think one important note is because for those of you that were present in our previous countries conferences, we did roughly the same job. We looked at economies, what are hot topics, what is those ones that we should focus on. But this time it will be a little bit different because Christiane took over Austria, and perhaps that's the reason why it is so Austria-focused.
Yeah, sorry. I was so happy that I now have so many data on Austria. I want to share them with everybody.
Exactly. And as you will see in a few minutes, actually Christiane developed a really good view with various indicators on Austria, with some kind of forward views on that. But let's start with our global picture. And this global picture, if you are familiar with our, let's say, economic research products, this is one of the top products that we have. Those are country risk assessments. And country risk assessments, for those of you who have not seen that before, is those that we do those risk assessments on various countries, actually on more than 160 countries, so a bulk of the world. And here we conclude various indicators. Of course, we take into consideration those economics ones, so macroeconomics, but also financial indicators, political situation, environmental situation in particular countries. So we are something similar to rating agencies in this part. But we add to that our payment experiences, what brings somehow microeconomics issues to those assessments, and also business climate assessment. And what we have right now, to tell you the truth, I have really mixed feelings, because on one hand, recently we did lots of downgrades. As you can see, those circles with, and what's the color, green, blue? Anyway, indicated as upgrades. Okay, thank you. Indicated as upgrades. There were lots of upgrades recently, but at the same time, as you can see, there is lots of red on this map. And the scale is at 8 scale grade, going from A1, very low risk, to E extreme. And when it gets more red, it's more risk, and there's a lot of risk right now, although, as I said recently, we did lots of upgrades. We upgraded some countries in Europe, like Ireland or Greece. We also upgraded those countries which base on producing of hydrocarbons, of oils, like, for example, Qatar, Saudi Arabia, Kazakhstan. But if we look back, we downgraded in 2022 lots of European countries, and still lots of those European countries are unfortunately in lower assessments than they had before the pandemic.
Yeah, sorry guys. So I have to admit, On behalf, as you probably know, I am German, and on behalf of Germany, I deeply apologize to every single one of you, because Austria had to be downgraded to A3, because Germany was going down with A3. It's the old story, you know it. Austrians are solidaric with the Germans, and mitgehangen, mitgefangen. This is how we call it. So again, I'm very sorry. I know we are one of the main export and trading partners, and because we are not developing, you are not developing, unfortunately. And that's why we are both stuck together in A3, which is the lowest grade that we had since 2003. So I just looked it up. I have to say, we started in 2003 with an A1 for Austria. No? Look how everything turned down since we took over.
Well, in 2043, I'm sure it will be A1.
Hopefully.
Yeah. Okay, so what's actually happening in the global economy? This is the chart on the left-hand side that you can see that starts in the last quarter of 2019. It's quite a long. It's the pre-pandemic period. Those are more than 4 years. Yeah, let's say like in total years, it's 4 years. Well, I think on one hand, this is the history, because we hope that once it was the pandemic, there was a recovery in the late 2020. Yeah, we had quite a good trend of improving economies. But as you can see, this chart is still valid to comparison to this pre-pandemic level. As you can see, lots of countries, including Germany, are at the same level that they were in the last quarter of 2019. Austria is better, but not significantly better. Actually, the outperformer here is the Chinese economy.
Yeah, but it's a developing economy, and I know if you would show your beloved Poland, it would have been way up, but...
It would be, but we didn't have so many colors to show Poland here. Also, if we would add some emerging countries, they would be better. And what we have recently, we just updated our GDP growth forecasts. And what we've seen previously, that global GDP growth will reach just 2.4% this year. And we hope that the same growth will be the next year. But unfortunately, it seems that 2024 is going to be more challenging with the global GDP growth rate at 2.2%. And whereas we thought, we still think that it will be the slowdown driven by advanced economies, unfortunately, right now, there are more also emerging countries joining that group of a slowdown, including, for example, China, including India. Those countries which are going to grow, for example, China 4.5% this year, will grow 4%. Okay, we would like to have countries in Europe growing in such a scale, but nevertheless, this is an emerging country. China used to be growing 10% or even more in previous years. So here, I mean that, okay, it's a slowdown at advanced economies, but unfortunately, with this deteriorated global trade and deteriorated global situation, we have also other countries joining those negative group.
Yeah, and to this group, unfortunately, Austria belongs, as you see here. That's the GDP development and the contributors to GDP growth. And I think there's many things that that are not out of surprise for you. So the dark blue one, private consumption. Private consumption is not doing well. And I think most of you felt it at some point. The high inflation, I know that from January on there will be a little bit higher wage, but is this really taking up the purchasing losses that you had, the purchasing power losses that we all and you all had established in the past? Also, investments are going down. We will talk about central bank policy in a minute. What I personally found striking still was here in the last quarter, if you look at this brown grayish part, that's net exports. Net exports means international trade, exports minus imports. And if I would show you here the one for Germany or the Netherlands, we see that global trade is not doing well. So we discussed this morning, where is it coming from? And the problem is, and I checked it unfortunately, it is not coming from the fact that you have more exports, but that the imports are decreasing. Imports, less consumption. So we see here, after a short technical recession, means 2 quarters in a row with negative growth, we had a little bit of recovery. Now we are at minus 0.7. And unfortunately, we do not think that this development will change in the second half of the year. And for the next year, only a very mild recovery, really step by step. The main reason, normally when we were in this situation, we had somebody else to push us, like China, like the US. But as Grzegorz just said, China and the US are not developing. Everybody is waiting for the other to develop. And that's the problem. If everybody is waiting, everybody is coming to a halt. And when you are at a halt, it is even more difficult to get away from that. Maybe we will talk about now the inflation, so that we can...
Perhaps just one comment to the chart you included here on Austria, because it's really it's very interesting. As you said, net exports could come also from weaker levels of internal consumption of that people consume less, and actually we've seen it in the private consumption. So this dark navy part that in last quarter it was negative. It's not only household consumption; it's that also, for example, what you import, what companies import for their production, because not all components, not all inputs, parts are produced here in Austria, but they are imported. And also, as you can see, this part, light blue part that is here, it's decrease of inventories. This is what we have, as Christiane said, we have lots of countries. The global situation is very similar to that what is happening in Austria. We have destocking process. So this stocking process was already done once we had this recovery from the pandemic, once the prices were increasing. But right now, it's not that the demand is here and companies increase in the inventories. Actually, this is the opposite. They decrease that, and this is the stocking process is also putting growth lower. I think that is seen not only in Austria, but in lots of other countries. And also, like here in Austria and in other countries, we have those factors that are limiting demand. And insufficient demand limits activity of various companies. I checked the recent data, the survey data, and a year ago, in the middle of 2020, just 2% complained on insufficient demand as a factor limiting their production. That was in Austria. And right now, according to latest data, there are 22%. So that's that's more than labor shortages, and we see that also in lots of other countries, that insufficient demand is the factor that limits the business operations of companies, and as a result, also the economic activity.
And now we get to inflation. Come on. At some point, we cannot avoid it anymore.
Yes, exactly. It got like, it's a boring subject right now, but it's still there.
So you see here on the left-hand side of you, the Austrian inflation development and its components. I think that's really interesting. And when we talk about high inflation, I know that you all think that Austria had the highest inflation rate in the Eurozone. Was that the case?
No, I don't know why you're asking me. Okay, I know, because indeed in Central and Eastern Europe it's much bigger. But take a look. It started to drop, it's better.
Yes,
you've heard in media, it's better. Inflation is going down.
Okay. But the reason for that is that transport went down. So everything that's pink, these are transport costs. So fuels, e-tickets. Okay, I have to say, I mean, I passed here a gasoline station. You are 20 cents lower than what we have to pay in Germany. Maybe, do you think I can take a canister of gasoline with me on the plane?
Why not?
As some kind of souvenir. So we see here a decrease in prices. We also see that food prices are slowly coming get a little bit lower when we look at the component, but only a tiny bit. And you see here that especially this gray part, which is others. Others mean everything that is not else here named. Everything without energy, everything without food prices. This is what we call core inflation rate. And the core inflation rate, this is also what central banks are looking at, because the rest can be very volatile. You have seen that in the past. But the problem is this part increased a lot, and it is above 3%. And that's the problem that we are facing. That's nothing that will change that fast. So even if we take all the other part down, the inflation rate will not come down that fast as much as we would wish for it. Indeed, when we are looking now from Austria to Europe, again, Austria is a very good example for the rest of Europe, but if we are looking now at European consumer prices, because the ECB is looking at European consumer prices, you see here an interesting pattern. You see here in dark blue the yearly inflation rate, what we are looking at, and what was the monthly price pressure. And there were some months where it was extreme. just pretend that we have a moderate sideward development of monthly price pressure, which would be completely normal. Even then, yes, the inflation rate will go down a little bit more, but then have a sideward development. And at the end of next year, at the end of 2024, we will be still at 3.7%. 3.7% is not 2%. That's easy maths as far as we get here. And this means that the central bank, the ECB, is looking extremely at that and has increased the interest rates again in the September, but will now keep it on hold on this quite high level.
Yeah, actually I was provoking you with this disinflation process because indeed it started to decrease, but let's remember this disinflation is not deflation. It's not that the headline inflation is negative. It's that the acceleration of prices is not as huge as it was previously. If you compare the latest figures with those figures a year ago, it's another increase after already high soaring level of prices. And also even a year before, it was already increasing. So indeed, prices are higher. And I think we could have some surprises. Well, that's the question if surprises, because, for example, oil prices are right now increasing. This morning it was $94 per barrel, I mean Brent oil price. Mm-hmm. We have OPEC plus countries which are really dedicated to have limited output. They cut output. They care about supply, limited supply, because they know that demand is really limited, so it will not trigger the increase of prices. So that's why for the inflation we can unfortunately have some surprises that, as you said, it will not come back to inflation target so fast as we expect.
Indeed, and that's why the central banks are going so up so fast. So if you're looking here at the left-hand side, you see the development of the Fed and the ECB. In key interest rates means in ECB terms, main refinancing rate. And you see that we are only one step, 25 basis points away from the highest level. And the highest level was even before 2003. So we are actually coming back. It's a little bit as if they have planned for this anniversary to go back to this high interest rates that we had in the early 2000s. Of course, nobody of us is really... We have adapted to the low inflation level for quite a long time and the low interest rates level, and this is the big change. The US Fed is doing, by the way, the same, but there are actually central banks who are not that high but go down now.
Yes, it is. Actually, in my home region, so Central Europe, we have the central bank that started to decrease interest rates, namely Polish central bank decreased interest rates by 75 basis points this month. And I think this is a big question that rate setters have right now, to sacrifice inflation or to sacrifice growth. It seems that most of them, especially those big, large central banks from advanced economies, they care a lot about that what will be with inflation, to put inflation lower and then to wait once there's a really recovery. I don't know what's the best solution, but I think indeed with still high inflation and still lots of pressure, possible pressure for inflation, we could have negative surprises if central banks would decrease interest rates too fast.
Well, I mean, what they also do is not only work on interest rates, but also on the asset purchases. I think maybe you still remember it. A year ago, nobody talked really about interest rates. It was more about what about quantitative easing. Quantitative easing here and there, and this program and that program. They had nice names, APP, PEPP, whatever. Now they are going back from these high levels, but you see it here. These are the assets in the balance sheets of the Fed and the ECB. It is still quite a high level. So there is still liquidity in the market to support economies, to support also sectors. And I think we should jump to the sector outlook here.
Yes, in terms of sector risk assessments, it's quite comparable with country risk assessments because we have a lot of red color here.
It's orange, come on.
Orange.
That's orange.
Orange, okay. Orange and red.
Man and color.
She's better in colors than I do. As you can see, we did lots of downgrades, but also we started to do some upgrades. That's namely so far the transport sector. But this transport sector, that depends a lot, because when you refer to Western Europe, to various other regions, indeed. Easing of supply chains helped a lot.
Yeah.
We do not have such a shortage of containers, such high prices of containers that it used to be during the peak of that shortages that we had in terms of various goods, various components. Also improved passenger transport, but honestly, if I would put here Central Eastern European region, that would be still in negative area, because in Central Eastern Europe we have lots of dependence on the road transport, road international transport, and this is still weak, and this is still hurt a lot by that what is happening in Europe, in Western Europe and in Central Eastern Europe. So slowdown and recession.
Hey, so there is at least one thing that is not better in Central Eastern Europe than with us.
That's it.
Austria, as you see here, is quite a lot in orange and a little bit in yellow. And I guess that you're all waiting for, yeah, but are there more upgrades? Well, it's wobbly right now. And I think from the economic environment that we showed you before, it is no surprise to you that it is that orange, but maybe we can step by step go a little bit into the yellow part. So let's go a little bit deeper into the sector area for Austria. I am very delighted to present to you exclusively now for the very first time my new map. It's a little bit Hollywood here. So I want to give you a little bit more transparency. I have to admit, it's not working like that. It's not that I have 4 different or 5 different indicators, look at it, see is there more red, is there more green, and then upgrade, downgrade. So if I would say that, then Susanna Kubandova will kill me later on, discreetly on the toilet, I guess. So it's not like that. We have, of course, many, many other factors, but I want to give you a little bit of insights, what's going on. We have on the left-hand side, first, insolvency development. Insolvency development of different sectors from the beginning to what we already have compared to the last year. You see a lot of 20%, and that's the reason because, unfortunately, we only have manufacturing, so I put every manufacturing sector in 20%. Activity and production means what is the production or what are, for example, retail sales in or transport on the street versus air transport for passengers this summer compared to last summer. Turnover is like activity, but this time with prices. You can have a decrease in activity, but if you can increase your prices as a company, you're still okay because you are not on the edge of insolvency. And then we have 2 leading indicators. First, the one from Ecofin for the general climate, Ecofin, the EU, and then the Ecofin expectation index, both for Austria. So one, how's the climate right now, and one, how could these things develop in the future, and then you have here the same country risk assessments that you saw before. So if we have quite a lot of green, like in automotive, this gives us the step where we say, okay guys, let's talk about it in our Europe group. Should we maybe think a little bit different now, slowly, about automotive?
Yeah, and actually we started to upgrade automotive outside Western Europe. We did such an upgrade for Romania already. It seems that the automotive sector has been performing well, really challenging times, because during the pandemic it was a strong decrease of demand.
Yes.
Then we witnessed quite fast, strong limitations of supply. Semiconductors, but also other components.
First no demand, then no supply.
Exactly. It has not, I think, recovered in terms of supply side really fully, but it's much better than it used to be. And here, I think it comes as a paradox, because we told you about, and you know that perfectly, about those decreasing retail sales, decreasing household consumption. And in terms of durable goods, it's seen. Like, for example, electronics, they drop a lot. But in terms of cars, vehicles, there's still demand. Of course, that comes not only from households, but also from companies renewing their car fleet and so on. But it seems, indeed, as Christiane said, there's lots of green color here for the automotive sector, and perhaps we hope that it could be an indicator of so awaited recovery, but I'm quite afraid of this word recovery, because it's not the time to say
We
it.
have to wait, we have to drink another glass of sekt with Susanna, and maybe we can convince her.
hopefully.
Hopefully. That's the plan for this evening for us. But I would say just jump to the insolvencies first.
Yeah, actually, I thought that we will finish with this automotive sector, with a positive message that we could have for the audience as the final part.
No, we have to take down the mood again.
But we have the insolvency slide, so sorry for that.
It's not okay if you are in a good mood when we leave the stage. So this is why we have to go back to insolvencies. And we want to show you a little bit of background when it comes to insolvencies. First, where do we start it in 2022? You see it here on the left-hand side. Already in 2022, we were almost back to pre-pandemic levels. That's a bad sign or a good sign, depends where you're looking at it. I personally see it as a good sign. Why? Because I have the feeling that in Austria, market powers are again working. There are not so much support measures behind, which keep actually dead companies still alive like a zombie, but let them die. Okay, now I really take down the mood, but you know what I mean, that there is not so much influence from the state behind. What we also see is that right now, numbers of insolvencies, as you see in the middle, have increased to a level that is a bit above 2019. Is this bad? Well, not technically, because on the left-hand side, you see that 2019 was already low level. So this is business as usual, normalization. And when we are looking at the different sectors, then it's interesting that transport is the one which has decreasing insolvencies. Construction is only there with 3%, so if everybody is complaining in the construction sector, they should have a stronger discussion with everybody in the hospitality sector. They can complain, but not so much the ones in construction.
And I'm not sure if you like it, but I think Austrian insolvency data is somehow between Central and Eastern European insolvency data and Western Europe. In Central and Eastern Europe, we already are back at pre-pandemic levels, in some countries above them, whereas in Western Europe, like for example in Germany, those are increasing, but the pre-pandemic levels are not there, right?
Exactly.
Here I think that there are lots of challenges ahead of us, as we said. Not only those hard data that we have, like industrial production, retail sales are weak, but also sentiment data. They do not indicate that we should expect a fast recovery, also from the point of view of new orders and so on. Hopefully, this deepest part was reached. Hopefully. This minus will be not so big like it used to be in previous months. But at the same time, if we have so many challenges, unfortunately, those lines, those bars here, they are going to increase.
Indeed. And that's, I think, a good time to finish because we got the mood down.
Thank you.